Hey everyone, welcome back to Corporate Decoder, the place where we expose the secrets behind the balance sheets and see if companies can actually walk the talk. Today we're diving into Vestand Incorporated's latest filing, and let me tell you, it has got a bit of a rocky read. Vestand Inc. is sending out a notice that might make some investors a little nervous. It is all about their stock price and whether it is high enough to stay on the big leagues, the Nasdaq stock market. Now, Vestand Inc. has class a common stock that trades on the Nasdaq capital market under the ticker symbol VSTD. This company is considered an emerging growth company, meaning it is still relatively new and might be using some extended transition periods for new accounting rules compared to older, more established companies. This filing is a Form 8, which is like a current report that companies have to file to announce major events that shareholders should know about. The most important date here is the 12th of December 2025, which is when the company first learned about the issue. So, what is the big deal? Well, Vestand Inc. received a notice from Nasdaq, the stock exchange, saying they're not meeting a basic rule for being listed, the minimum bid price requirement. Basically, for a stock to keep trading on Nasdaq, it generally needs to be worth at least $1 per share. For the last 30 days leading up to the 11th of December 2025, Vestand Inc. stock had been trading below that crucial $1 mark. Now, Nasdaq doesn't just kick companies off immediately. They gave Vestand Inc. 180 days, which is about 6 months to fix this problem. They have until the 10th of June 2026 to get their stock price back up to at least $1 and keep it there for 10 straight business days. If they can do that, Nasdaq will confirm they're back in compliance and the issue will be closed. But what if they can't? The filing outlines a couple of other options. If Vestand Inc. can't get their stock price up organically, they might be able to do something called a reverse stock split. This is where a company reduces the number of outstanding shares, which in turn artificially increases the per share price. Now, this can be a tricky maneuver. If they do a reverse split and the stock price then falls below $1 again within a year, Nasdaq could issue a delisting determination right away without giving them another chance. There is also a really serious warning. If the stock price drops to 10 cents or less for 10 consecutive trading days, Nasdaq will immediately start the process to delist the stock. That means the company would likely be moved to a less regulated exchange or even completely off the public market, which is a huge red flag for investors. The company is being pretty upfront here, stating that there is no guarantee they'll be able to get back in compliance. They are considering their options, but as of the filing date, no decisions have been made. This cautious language suggests they might be facing significant challenges in turning things around. The filing also mentions exhibits, and one of them is the cover page interactive data file. This is basically a standardized electronic document that helps communicate information from the filing. The report is signed by Ju-won Kim, who is the Chief Executive Officer of Vestand Inc. This confirms that the company leadership is aware of this situation and is signing off on this official notification. Now, let's put on our investor hats and really think about what this means for Vestand Inc. The core issue here is a low stock price. When a stock consistently trades below $1, it can signal a few things. It might mean investors have lost confidence in the company's future prospects, or perhaps its business isn't performing as well as hoped. For a company aiming to grow, being delisted from a major exchange like Nasdaq would be a serious blow. It makes it harder to raise capital, harder for employees to have liquid stock options, and generally damages the company's reputation. The fact that they are considering a reverse stock split is a common tactic, but it doesn't actually fix the underlying business problems. It is like rearranging the furniture in a burning house. If the company's fundamental business isn't strong enough to support a stock price above $1, a reverse split will likely just be a temporary fix, and the stock could drop again. The real challenge for Vestand Inc. will be to improve its business operations and financial performance so that investors gain confidence and are willing to pay more for its shares. The biggest risk highlighted here is the possibility of delisting. If that happens, the value of the company's stock could plummet even further, and it would become a much more speculative investment. The opportunity, however, lies in whether they can successfully execute a turnaround strategy. If they can show real growth and profitability, they could regain investor trust and avoid delisting. Ultimately, Vestand Inc. is in a precarious position. The low stock price is a symptom of underlying issues that need to be addressed. While they have some time to try and fix it, their lack of assurance about their ability to regain compliance is a significant concern. For investors, this filing should be a clear signal for caution and a prompt to thoroughly investigate the company's financials and business strategy before making any investment decisions. Alright, that is our breakdown of Vestand Inc. Latest filing, what is your take on these numbers and what they signal for the company's future? Do you think they can turn things around? Or is delisting inevitable? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord community linked in the description below for more exclusive content and discussions. Thanks for watching. See you next time.